The world operates on a terrifying, hidden truth that the collapse of once great industrial civilizations is not a sudden, unpredictable catastrophe, but a mathematically inevitable process engineered by a few, profited from by fewer, and experienced by the masses with paralyzing shock. We are not speaking of simple economic downturns or cyclical recessions. We are speaking of a structural, national amputation, the quiet, calculated dismantling of the productive core of a nation, leaving behind a hollowed-out shell dependent on the very architects who designed its demise. This is the industrial collapse pattern, a template of systemic decay that has devoured the British Empire, flattened the American Rust Belt, and is now, with mechanical precision, concluding its cycle across the entire United States. The initial tremors are already shaking the ground beneath our financial foundations, yet the official narrative insists on stability. This denial is the first and most critical stage of the collapse itself. The architects of this erosion are not external enemies. They are the high priests of financialization, those who discovered that manipulating debt and currency offered infinite, immediate returns far superior to the laborious, single-digit profits of building things. They perfected the strategy of substituting paper wealth for real wealth, thereby creating an instability that is not a bug in the system, but its primary, inescapable function. To understand the present danger, we must first accept the shocking reality of this pattern's repetitiveness. Whether it was the slow decline of the mighty British shipbuilding industry after the 1,960 seconds, or the instantaneous shuttering of massive manufacturing plants in Ohio in the 1,980 seconds, the operational procedures were identical. Strip the assets, burden the productive units with unsustainable debt, offshore the labor to arbitrage global wage differentials, and finally, replace national productivity with financial speculation. This process, driven by short-term shareholder returns and political expediency, is inherently self-liquidating. It establishes a fatal dependency loop. As production declines, tax bases shrink, forcing governments to borrow more, which increases the power of the financial sector, which, in turn, accelerates the deindustrialization in a quest for higher yields. This is the inescapable feedback loop of industrial decay, and it functions with an almost chilling certainty. The core conflict is between the slow, steady creation of real value and the fast, predatory extraction of perceived value. The financial elite who govern the shadow economy, the massive, unregulated flows of global capital, knew precisely what they were doing when they championed the shift from an industrial economy to a service and debt-based one. They understood the leverage. A nation that builds its own products controls its destiny. A nation that finances the purchase of goods built elsewhere is perpetually a tenant, not an owner. The moment the priority shifted from maximizing national productive capacity to maximizing quarterly profit reports and CEO bonuses, the clock on the industrial collapse pattern started ticking. This wasn't a mistake. It was a strategic choice. The vast, geographically concentrated manufacturing base of the 20th century became a target, an enormous, tangible asset base waiting to be optimized and stripped clean through the leverage of debt and the promise of global efficiency. This industrial foundation, the very source of America's post-war dominance, was too big, too slow, and ultimately too valuable not to be cannibalized by the financial masters. The resulting instability, the mass unemployment, and the social dislocation were simply acceptable collateral damage in their pursuit of infinite growth and wealth concentration. This narrative, that the collapse is engineered, not accidental, is the critical lens through which we must view the current economic landscape. We are past the point of simple warning. We are now dissecting the final chapter of a history that has been told and ignored many times before. The consequences of this structural demolition are not theoretical. They are visible in every shuttered factory, every decaying municipal balance sheet, and every exponentially rising national debt figure. Now let's deconstruct the architects, the blueprints, and the final stages of the collapse we are currently living through. To recognize the pattern's end stage in the United States, we must first trace its most comprehensive historical execution, the slow, systemic dismantling of the British Empire's industrial core, a phenomenon chillingly dubbed the British disease. This was the true testing ground for the financial mechanisms of deindustrialization, proving that even centuries of global dominance could be dissolved not by invasion, but by internal financial and political decay. Britain, the progenitor of the Industrial Revolution, found itself trapped in a post-war economic paradigm where its productive assets were increasingly viewed not as sources of national strength, but as low-yield investments to be liquidated or leveraged. The fatal confluence occurred in the 1,960 seconds and 70 seconds, defined by the financial elite's successful lobbying for policies that prioritized monetary control and global free movement of capital over the preservation of domestic manufacturing capacity. The British disease manifested through a series of politically expedient decisions that structurally wounded the national economy. First was the rise of the short-term political cycle. Governments faced with challenging union demands and the immense capital investment required to modernize aging factories, a direct challenge to the post-war industrial legacy, chose the path of least resistance, allowing industries to languish, then nationalizing them when failure was imminent, only to later privatize the remaining valuable pieces at rock-bottom prices. The ultimate form of state-sponsored asset stripping, shipbuilding, textiles, and coal, the pillars of British power, were starved of capital and innovation, while simultaneously being subjected to intense global competition they were structurally unprepared for. This created the perfect pretext for the financial architects, the narrative of uncompetitiveness. They argued that these industries were obsolete, when in reality, they were merely unprofitable under the restrictive short-term profit models imposed by the new financial orthodoxy. Crucially, the political class and the financial elite in London became intrinsically linked, creating a feedback loop of industrial negligence. The City of London, the financial hub, generated immense, immediate wealth through banking, insurance, and the management of global capital flows. This immediate liquid wealth eclipsed the slow, patient profits of the North's heavy industry. The resulting political and economic center of gravity shifted decisively from the factory floor to the trading floor. This wasn't merely a natural evolution, it was a deliberate choice enforced through regulatory capture and monetary policy. The UK's commitment to floating its currency and the later embrace of global financial freedom made its manufacturing base instantly vulnerable to higher interest rates and exchange rate volatility, pricing British goods out of the global market while making speculative foreign investment far more appealing. The core mechanism was debt. By allowing companies to take on excessive debt, often facilitated by the same financial institutions that would later oversee their liquidation, the stage was set for the collapse. When the inevitable downturn hit, the debt-laden companies, starved of modernization capital, became mathematically unstable, a condition exploited by corporate raiders and asset managers. The historical deconstruction reveals that the architects of the British collapse were masters of narrative control. They did not frame their actions as the destruction of national capacity. They framed them as optimization, efficiency, and global integration. The resulting ghost towns, the mass unemployment, and the deep social stratification were simply externalities, an acceptable cost for the privilege of becoming a global financial center. The UK traded real, tangible economic sovereignty for the ephemeral abstract power of global finance. This systemic failure provided the ultimate blueprint for the American pattern: the calculated neglect of the productive base, the elevation of short-term financial metrics over long-term national solvency, and the fatal entanglement of government policy with the demands of the financial elite. The UK's painful transition from the workshop of the world to a service and finance economy was not a unique tragedy. It was the world's first successful, full-scale execution of the modern industrial collapse pattern. This historical precedent is what provides the present danger with its predictive certainty. The industrial collapse pattern is not an abstract economic theory. It is a mechanical, three-stage process applied with mathematically precise choreography by the financial architects. We must deconstruct these stages, as understanding them allows us to pinpoint the exact moment of danger in the current U.S. economy. Stage 1. Financialization and debt loading, the setup. This initial phase is characterized by an explosion of complex financial products and the systemic redefinition of a company's purpose. In the 20th century, a company existed to build things, employ people, and return measured profit. In the financialization era, a company exists solely to maximize shareholder value, often measured through immediate stock price and leveraging assets. The architects introduced leveraged buyouts, LBOs, junk bonds, and the priority of quarterly earnings over long-term capital expenditure. This is where the core industrial assets factories, machinery, proprietary knowledge are systematically recategorized from productive tools into mere collateral. Private equity firms and corporate raiders, acting as the primary agents, strategically load productive enterprises with debt, often using the target company's own assets as security for the loan used to acquire it. This maneuver immediately restricts the company's ability to modernize or withstand economic shock. The resulting burden of debt service starves the operations, creating the manufactured narrative of inefficiency needed for the next step. Stage 2. Operational arbitrage and offshoring. The takedown. Once a company is mathematically unstable due to debt, the architects move to extract maximum immediate cash flow. This phase is characterized by the systematic exploitation of global economic differentials. Manufacturing is shifted overseas to regions offering the lowest labor costs, the weakest environmental regulations, and the most favorable tax structures. This is branded as global optimization, but its mechanical function is singular: to arbitrage national loyalties and labor protections. When a factory closes in Michigan or Manchester, the value extracted is not merely the reduced labor cost. It is the immediate unlocking of the capital, tied up in the domestic infrastructure, now available for speculative investment. The crucial, often missed point here is the destruction of the integrated supply chain. Industrial capacity relies on a dense ecosystem of specialized suppliers, technicians, and engineers. Offshoring one major operation degrades the entire national ecosystem, making it almost impossible to restart domestic production efficiently, even if geopolitical necessity demands it. The architects destroy the system's resilience in pursuit of the short-term yield. Stage 3. Asset stripping and intellectual property extraction. The liquidation. This is the final, irreversible phase. The physical remnants, the factories, the land, the machinery, are sold off for their scrap value or converted into low-value real estate warehouses, retail parks, erasing the evidence of national productive capacity. More insidiously, the core intellectual property, IP, the patents, the designs, the operational blueprints, is transferred to the offshore entities or sold outright. This extraction ensures that even if labor costs were to normalize or geopolitical conditions shift, the original nation can no longer easily rebuild, as the critical knowledge base is gone. The original company is reduced to a pure financial entity, a shell focused entirely on managing its remaining debt, leveraging its brand name, or participating in the service economy that caters to the financial elite. The mechanical output of this three-stage process is twofold. First, the vast instantaneous concentration of wealth into the hands of the financial architects who manage the stripping operation, and second, the creation of a massive, structurally unemployed workforce dependent on state subsidy, which in turn requires further borrowing, solidifying the power of the lenders. This entire mechanism, applied with chilling repetition from the UK to the US Rust Belt, demonstrates that the collapse is not a failure of business, but the ultimate success of financial engineering. This is the mechanical precision of wealth transfer disguised as economic evolution. The instability is inescapable because the system is designed to consume its own foundations. The collapse of Detroit is not merely an urban tragedy. It is the textbook, high-resolution visual evidence of Stage 3, the terminal phase of the industrial collapse pattern, and it serves as the most potent warning sign for the wider American economy. Detroit transitioned from the undisputed global engine of manufacturing and innovation to a symbol of structural decay with frightening speed. This swift downfall was dictated by the same mechanical stages that felled Britain, but compressed and accelerated within a single metropolitan boundary. For the financial architects, Detroit was the perfect target, a massive concentration of physical assets tied to politically powerful but financially short-sighted organizations, the big three automakers, and a municipal government unable to resist the lure of external debt financing. The pattern applied to Detroit began with the financialization of the automotive industry itself. Corporate leadership, responding to shareholder pressure and the logic of global arbitrage, began prioritizing financial metrics over engineering dominance. Massive debt-financed mergers and acquisitions replaced patient capital investment. Pensions and long-term liabilities became balance sheet anchors, leveraged by the financial architects to justify the need for restructuring. Then came the operational arbitrage. Production was systematically offshored, first to non-union states, then globally, leaving behind colossal, valuable but functionally redundant factories. Crucially, the economic contagion spread immediately to the dense network of supporting industries, the tool and die shops, the parts manufacturers, the engineering firms. The collapse was multiplicative, not additive. Every job lost in the assembly plant led to 3 or 4 lost jobs in the supplier ecosystem. This decimated the city's tax base, leaving the municipal government fiscally unsustainable. The architects, holding the debt instruments, then presented the government with the only apparent solution: further borrowing, deepening the dependency loop and enriching the bondholders. The final, brutal stage asset stripping and liquidation is what defines modern Detroit. As the city's ability to generate revenue evaporated, municipal services degraded, property values plummeted, and a negative feedback loop took hold. People left, further reducing the tax base, necessitating deeper cuts. The ultimate act of financial control came with the city's 2013 bankruptcy. While the public narrative focused on bad management, the bankruptcy was a precise financial mechanism that permitted the legal restructuring and often the abrogation of liabilities, while prioritizing the repayment of specific bondholders and financial entities. It was the complete legal transfer of control from the democratic process to the financial creditors. What was left was a municipality with a drastically reduced capacity for independent action, its remaining assets often sold off to satisfy financial obligations. Detroit became the ultimate hollowed-out city, a proof of concept for the complete industrial collapse. The present danger is that the U.S. economy is now demonstrating the precise indicators of systemic decay that preceded Detroit's final implosion, but at the national scale. The current American economic structure is fundamentally a debt service economy disguised as a consumption economy. We see the exponential growth of national and corporate debt, not for productive capacity, but for share buybacks and speculative leveraging, the purest form of stage 1. We see the continued regulatory capture, prioritizing high-frequency trading and financial innovation over supporting the remaining domestic industrial base. The supply chain crises of recent years expose the fragility inherent in a structure built on global arbitrage. The critical difference today is the sheer magnitude. When the debt-laden, unproductive national structure inevitably collapses, there is no larger economy to absorb the shock. The pattern is now consuming the entire host. The inevitable stage 6 or 7, the complete loss of financial and productive sovereignty, is mathematically certain unless the entire mechanical process is reversed, a feat that would require an unprecedented political and financial pivot away from the elite architects who profit from the current structure. The analysis of the industrial collapse pattern, from the UK's slow decay to Detroit's terminal velocity, forces a profound and inescapable conclusion. The final stage of this mathematically unstable process is not a crash, but a sovereignty crisis. The current American economy is not merely facing a recession. It is facing the moment where the financial debt, leveraged by the architects, finally consumes the nation's remaining productive and fiscal independence. The indicators are screaming the proximity of this final stage. We are witnessing a level of systemic risk where the Federal Reserve and the Treasury are perpetually engaged in crisis management, applying infinite liquidity to prop up markets that are structurally unsound. This constant intervention is the hallmark of a system that has become too leveraged to function independently. The debt-to-GDP ratio has breached historically significant thresholds, meaning that the nation's ability to generate real wealth is being outpaced by its need to service its obligations. The ultimate sign of the financial elite's success in substituting paper claims for real production. Furthermore, the relentless expansion of the service and financial sectors, while domestic manufacturing contracts or remains entirely reliant on fragile global supply chains, demonstrates the completion of the structural shift. The American economy is now structurally designed to manage and trade debt rather than to produce goods, perfectly fulfilling the template established in London 50 years ago. This is the ultimate moment of decision, the highest level of dramatic tension in this narrative. The collapse is not a theoretical event in the future. It is a structural state we are already existing within. The question is no longer if the unsustainable debt and speculation structure will liquidate itself, but how the individual is positioned when the final mechanical phase, the definitive transfer of assets and control occurs. The architects and the families they serve have already prepared. They hold hard assets, non-correlated investments, and control over the very financial rails that govern the inevitable restructuring. The vast majority of the population remains reliant on the system's smooth operation, a stable job, functional supply chains, and the perceived stability of fiat currency. When the pattern concludes, manifesting as rapid currency devaluation, mass unemployment driven by corporate deleveraging, or a complete financial market fracture, those who relied solely on the system will be consumed by it. Clarity, therefore, is the only remaining shield. The historian and analyst must conclude by stating the scientific certainty. The current path is mathematically unsustainable. Preparation demands a fundamental pivot away from financial instruments designed to support the failing system and towards real, tangible assets that retain intrinsic value independent of the debt cycle. This is the end of the deconstruction, but not the end of the process. We have traced the blueprint of national industrial collapse, analyzed its mechanical stages, and identified its terminal velocity in our present reality. The shock and the outrage are temporary. The structural shift is permanent. What remains is a quiet, profound reflection on the true nature of wealth, the illusion of the abstract numbers versus the cold, hard reality of tangible value. The architects of this cycle have profited by understanding this difference, exploiting the gap between what is real and what is claimed. Now, you possess the knowledge of their blueprints. The final stage of the collapse is not a spectacle of destruction, but a quiet, final transfer of wealth. The ultimate choice facing you is not whether to survive the crash, but whether to profit from the collapse or be consumed by it.